$847,000. That is the number. Not 1 million, not 2 million, not the 4 million your financial advisor quotes while adjusting his watch. $847,000. And I'm going to show you exactly where it comes from, why the industry buries it, and more importantly, why getting the number wrong in either direction will wreck you just as badly as not saving at all. Here's the thing most retirement calculators won't touch. For the median American household, retiring on $847,000 is not just possible. It is mathematically equivalent to retiring on 1.5 million once you account for Social Security, actual spending patterns, and the real way the tax code treats retirement income. The gap between those two numbers, that is not a math difference. That is a marketing difference. And I am going to show you exactly why the people selling you the "you need 2 million" story have a very specific financial incentive to keep you terrified. But before I get into that, there is a subplot I need to introduce. A guy I'll call Kevin. Kevin saved for 31 years, did everything right, hit $1.2 million in his 401k at 63, retired with confidence, and 4 years later was having panic attacks about money in his kitchen at 2 in the morning. I'll come back to Kevin. His story is not what you think it is. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use assumptions that haven't been updated since the 90s. Mine uses BlackRock and Vanguard's actual modeling logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link is in the description. Okay, the leaky bucket. Here is the metaphor I want you to hold on to for this entire video. Retirement savings is a bucket. You spend your working life filling that bucket every paycheck, every contribution, every year of compound growth poured in. Then at retirement, you flip a switch and start drinking from it instead of filling it. Most retirement advice is about how big to make the bucket. Make it bigger, fill it faster. Bigger bucket, safer retirement. The industry loves this framing. You know why? Because bigger buckets mean more assets under management. More assets under management means more fees. But here's what nobody is telling you. The bucket has holes in it. It has always had holes in it. Inflation is a hole. Fees are a hole. Taxes are a hole. Healthcare costs are a hole. And the cruelest hole of all, which I'll get to in a few minutes, and it will genuinely change how you think about this, is the order in which the market moves in your first 5 years of retirement. Not the average return, the sequence, the timing. Most people spend their entire careers focusing on filling the bucket. Almost nobody focuses on the holes. And that is exactly why people with $1.2 million end up having panic attacks at 2 in the morning. That's Kevin. We'll get there. So, where does $847,000 come from? Let's do this math clean, from scratch, because the number is not random and it is not a clickbait invention. It comes directly from 3 data sources that I'll name out loud. The Bureau of Labor Statistics Consumer Expenditure Survey, the Social Security Administration's 2025 benefit data, and a piece of research from 1994 that every serious financial planner knows about, but most clients never hear about. Start with spending. According to the Bureau of Labor Statistics 2022 Consumer Expenditure Survey, the most recent comprehensive one, Americans aged 65 to 74 spend an average of $55,916 per year. That is the actual number. Not what they wish they spent, not a motivational budget from a podcast, what they actually spend on average across housing, food, transportation, healthcare, and everything else. Round that to $56,000 per year. That is your target income in retirement. Now, how much of that comes from Social Security? As of January 2025, the average monthly Social Security benefit for a retired worker is $1,976. That is directly from the Social Security Administration's published data. Multiply by 12. That is $23,712 per year coming in automatically without you touching your investment portfolio at all. Subtract that from your $56,000 target. You now need to generate $32,288 per year from your own savings. Now, here is where the 1994 research enters the picture. A financial planner named William Bengen, not a celebrity, not a TV personality, a working planner with real clients and real responsibility, published a paper in the Journal of Financial Planning in October of 1994. He tested every 30-year retirement window in American market history and asked a simple question: what is the highest percentage of your portfolio you can withdraw annually without running out of money over 30 years, tested against the absolute worst historical scenarios? His answer was 4%, not 5, not 6, not the 8% some fee-based advisors quietly bake into your personalized retirement projection. 4%, and this held even through the worst sequences: the Great Depression, the stagflation of the 70s, 2001, 2008, 4% survived all of it. So you need $32,288 per year from your portfolio. Divide that by 0.04, the 4% withdrawal rate. The number you get is $807,200. The difference between that and $847,000, roughly $40,000, is a buffer for state tax variation on Social Security income. Slightly above average healthcare exposure in the first 5 years of retirement, and a small sequence of returns cushion that I'll explain. But the core number is not mystical. It is constructed from actual published data, and it is significantly lower than what most of the financial services industry wants you to believe you need. You think the problem is that you haven't saved enough? But actually the problem is that you don't know what enough means. And the people who could tell you have no financial incentive to be honest about it. Here's how that incentive works. And I find it genuinely, almost impressively brazen. The average financial advisor charges between 0.5 and 1.5% of assets under management per year. Let's call it 1%, which is conservative. On $847,000, that's $8,470 per year flowing to your advisor off the top every year, regardless of whether they beat the market, underperform the market, or just send you a quarterly PDF you never open. But here's the thing. If your advisor convinces you that you actually need $2 million before it's truly safe to retire, which is not an uncommon framing, then you're a client for another 8 to 12 years. Another decade of fees on a growing portfolio. The incentive to overstate your retirement number is not subtle, and it is not accidental. It is structural. It is baked into the compensation model. I'm not saying every financial advisor is a villain. I'm saying the system rewards advisors who keep clients scared, and that fact is worth knowing before you take any advice about how much you need to retire. Now, before I get into the holes in your bucket in detail, in a few minutes I'm going to show you something that Vanguard has modeled extensively, something that proves two people with identical portfolios, identical investment strategies, identical withdrawal rates, can have completely opposite retirement outcomes based on a single variable that has nothing to do with their skill, their savings rate, or their asset allocation. It's timing. And it is the most underestimated risk in all of retirement planning. But first, the holes. Hole number one, inflation. Everyone has heard about this one. Everyone nods and moves on. Here's the number most people miss. The Federal Reserve's stated inflation target is 2%. Over 30 years of retirement, sustained 2% inflation cuts the purchasing power of a fixed income by nearly 45%. Your $56,000 lifestyle in 2026 costs $101,000 in 2056 in nominal terms, assuming inflation behaves itself and nothing unusual happens. That is, by the way, an optimistic assumption. This is one reason the 4% rule works mathematically. Bengen's model accounted for inflation-adjusted withdrawals. You're not pulling a flat $32,000 every year. You're pulling $32,000 in year one, then $32,640 in year two, then $33,273 in year three. The bucket drains faster over time, not at a flat rate. Most people visualize their portfolio as a steady paycheck. It is not. It is a depreciating resource in a world of structurally rising prices. The bucket gets smaller faster than the spreadsheet suggests, unless your investments are outpacing the inflation rate consistently. Hole number 2, fees. This is the one that makes me genuinely wonder why more people aren't angry about it. If you have $200,000 invested in an actively managed mutual fund charging 1% per year versus a Vanguard total market index fund charging 0.03% per year over 30 years at a 7% average annual return, the fee difference costs you approximately $170,000 in lost compounding. That's on $200,000 of initial investment. 85% of your original principal gone not to bad investments, not to market crashes, just to the quiet, legal, ongoing extraction of a management fee that most investors cannot even tell you they're paying. Now scale that to $847,000. 1% annual fees on that balance, compounded over 30 years, at 7% return, costs you approximately $700,000 in foregone compounding. $700,000, that is nearly the entire retirement number, evaporated silently into management fees that you agreed to in a 60-page prospectus that nobody read. This is not a dramatic theft. This is a quiet one. And quiet thefts are worse because they never feel like emergencies. There's a parable about a miller who owned a grain mill. Every day he charged his customers a small toll, 1 grain of wheat per 100 that passed through his millstone. Nobody complained because 1 grain per 100 seemed trivial. After 40 years, the miller had accumulated enough grain to buy 3 of the farms that fed him. He had become wealthy not by growing grain, but by being present every single time someone else's grain moved through a system he controlled. The active fund manager is the miller. You are the farmer. And the millstone is your portfolio. Hole number 3, taxes. This one surprises people who haven't thought it through carefully. If your retirement savings sit in a traditional 401k or a traditional IRA, which is where the majority of American retirement assets live, every dollar you withdraw is taxed as ordinary income, not capital gains rates, ordinary income rates. If you and your spouse are pulling $56,000 a year from savings, you're sitting in the 22% federal bracket for the portion above $47,150. 13 states also tax Social Security benefits on top of that. You thought you had $56,000 in retirement income. After taxes, federal, state, Medicare premiums that scale with income, you might actually net $42,000 or $43,000, which means you need a larger portfolio than $847,000 to net the same lifestyle, unless you've done strategic tax planning in the years before retirement. This is specifically why Roth conversions during your 50s, when your income may be lower because you're past your peak earning years, but haven't started Social Security yet, can be worth more in lifetime wealth than almost any investment optimization you could possibly do. The hole in your bucket labeled taxes is actually patchable with deliberate planning and a willingness to pay some taxes early to avoid far more taxes later. Almost nobody does this systematically. Almost everybody should. Subscribe if you like this content. By the way, otherwise YouTube's algorithm may genuinely never surface my videos to you again. And this next section, sequence of returns risk, is the part I wish someone had explained to me in my 30s instead of my 40s. Okay? Stay with me here because this next part changes everything. 2 people, same age, same portfolio size of $1 million, same asset allocation, 60% equities, 40% bonds. Same withdrawal rate, $40,000 per year, which is exactly 4%. One retires in January of 2000. The other retires in January of 2003. The first person retires right into the dot-com crash. Over the following 2.5 years, the S&P 500 drops 49% from its peak. In their first year of retirement, they are withdrawing from a portfolio that is simultaneously collapsing. They are selling shares every month to fund their expenses, selling at the worst possible prices into a falling market. Those shares they sold at the bottom, they are gone. They will never participate in the recovery. The person who sold equity at half price doesn't benefit when that equity doubles back up because they already spent it. The second person, same portfolio, same allocation, Same withdrawal rate retired after the crash had largely played out. The market was already in recovery. They began drawing down a portfolio that was rising, not falling. Same starting balance, same strategy, completely different trajectory. Vanguard has run the modeling on this exact scenario. Two retirees with identical $1 million portfolios, identical 4% annual withdrawals, identical 60-40 allocation. The one who retired into a sustained down market can exhaust their portfolio 12 to 15 years earlier than the one who retired into a flat or recovering market. 12 to 15 years on identical portfolios. The difference is entirely timing. This is called sequence of returns risk, and it is almost never discussed by the people who sell you retirement planning because it exposes an uncomfortable truth that a significant portion of your retirement outcome will be determined by something entirely outside your control. And that is a hard thing to build a sales pitch around. Here is the thing about sequence of returns risk that makes it particularly brutal. It does not matter how disciplined you were during accumulation. It does not matter if you picked the right funds, maxed your 401k, lived below your means for 2 decades, read every annual report, and made every rational decision. If the market drops 40% in your first 2 years of retirement and you are withdrawing every month to cover living expenses, you are selling your future at a discount and you cannot buy it back. There's a parable I think about here. A farmer spends 40 years building the most efficient irrigation system anyone has seen in that county. He studies rainfall patterns going back 100 years. He installs the best pumps available. His pipes are immaculate and his reservoirs are full. And on the day he opens the floodgates to water his harvest, the drought of the century arrives. The reservoir is already half empty when he opens the valve. He has to pull muddy water through pristine pipes. He loses the crop anyway. 40 years of perfect preparation, undone by the timing of one catastrophic season. The bucket does not care how carefully you filled it. The bucket cares when you start draining it. So how do you actually defend against sequence of returns risk? I want to give you a framework here because vague advice about diversification does nothing actionable. There are 3 levels of defense, and most people, including Kevin, stop at level 1. Level 1 is a cash buffer. Keep somewhere between 1 and 3 years of living expenses in cash or short-term treasuries outside of your equity portfolio. In a market crash, you pull from the cash pile for your living expenses while your equities sit and recover. You don't sell at the bottom because you don't have to. This is correct and widely taught. Your financial advisor has almost certainly mentioned it. It is necessary, but not sufficient. Level 2 is a dynamic withdrawal rule. Instead of withdrawing a fixed amount every year, regardless of market conditions, you build a written personal policy. If your portfolio drops more than 15% in a calendar year, you reduce discretionary spending by 10 to 15% until the portfolio recovers. You remove the rigidity from the withdrawal math during the exact period when rigidity is most dangerous. Most people have the psychological flexibility to do this if they plan for it before retirement. Almost nobody plans for it before retirement. They plan for it after the panic attacks start. Level 3 is the uncomfortable one. Retire into income, not just assets. If you enter retirement with at least one stream of income that does not require selling investments, a small consulting practice, rental income, part-time work you actually enjoy, the sequence of returns problem shrinks dramatically. You are not forced to liquidate equity during a crash because you have cash coming in from somewhere else. You let the portfolio sit through the downturn and begin withdrawing only when conditions improve. Even covering 30% of your annual expenses with active income in years 1 through 3 of retirement can be the difference between the math working and the math catastrophically failing. This is where Kevin's story resolves. Kevin had level 1, 18 months of cash. What he did not build was a dynamic withdrawal structure or any income flexibility. He was withdrawing $60,000 per year above the 4% safe rate on his $1.2 million because he had always lived that way and had mentally committed to that number as the floor of his retirement lifestyle. The number felt earned. It felt like the reward. Cutting it felt like defeat. Kevin retired in late 2021. The S&P 500 finished that year up 26.9%. Great omen, right? 2022 happened. The S&P drops 19.4%. His bond allocation simultaneously loses 13%. 2022 was the worst year for the traditional 60-40 portfolio since 1937. Because interest rate hikes crushed bonds at the exact same time equities fell. Kevin was withdrawing $60,000. His portfolio wasn't recovering between withdrawals. It was shrinking faster than he modeled, compounding the problem with every check he wrote. By early 2025, Kevin's $1.2 million had dropped below $800,000. He had not spent recklessly. He had not made speculative trades. He had not done anything wrong by any conventional measure. He had simply retired with too high a withdrawal rate, no written dynamic withdrawal rule, no supplemental income, and the bad timing to step off the cliff right before a simultaneous bear market in both equities and bonds, which again happens roughly once per generation and which his retirement plan had never modeled. Kevin's problem was never the size of his bucket. Kevin's problem was the holes. And here's the kicker. Kevin's bucket was actually bigger than $847,000. He had more than the baseline. And he still ran into serious trouble because he ignored the mechanics of how you drain a bucket under adverse conditions. Now, let me come back to the $847,000 number and show you how it flexes across real situations. Because the baseline is the average, but you are not average. And understanding the variables that move your personal number is worth more than any generic advice I could give you. There are 4 variables. I want to name them clearly. Variable 1, Social Security timing. The difference between claiming at 62 versus waiting until 70 is roughly 77% more monthly benefit over your lifetime. If you claim at 62, you might receive $1,400 per month. If you wait until 70, that same benefit history could generate $2,400 per month or more for life, indexed to inflation. Every year you delay between 62 and 70 locks in approximately an 8% permanent benefit increase. That is a guaranteed 8% annual return on a government-backed, inflation-adjusted lifetime annuity. You will never find those terms in a brokerage account, not legally. Here's the math impact on your number. If delaying Social Security to 70 increases your monthly benefit from $1,400 to $2,400, from $16,800 per year to $28,800 per year, your portfolio now only needs to fund the gap between your spending and that larger benefit. If your spending is $56,000, your portfolio funded gap drops from $32,000 to $27,200 per year. Divide by 4%. Your required portfolio drops from $847,000 to $680,000. You just earned $167,000 without saving a single additional dollar just by waiting 8 years to claim. Most people claim Social Security early. The Social Security Administration's own data shows the average claiming age is approximately 64. People see the early payments as free money starting now rather than smaller money locked in permanently. It is one of the most expensive behavioral mistakes in American retirement planning. And it is almost entirely invisible because the cost is not a line item anywhere. It's an opportunity you never see because you already spent it. Variable 2, healthcare. I told you this was a wild card. Here is the card. Fidelity's 2024 annual retiree healthcare cost estimate found that a 65-year-old couple retiring today will spend an average of $330,000 on healthcare costs, not covered by Medicare, over the course of retirement. $330,000 on top of Medicare premiums, on top of regular living expenses. And that number assumes you stay reasonably healthy. One serious illness, one long-term care event, one diagnosis in your mid-70s, the number moves dramatically upward. Most retirement calculators fold healthcare into the average consumer expenditure figure, but the Bureau of Labor Statistics data underrepresents late-stage healthcare costs because it averages across all retirees, including the majority who are relatively healthy in their 60s and early 70s. The extreme costs come later and spike dramatically in the final 2 years of life. And those costs show up in statistics that most planning tools simply do not model at individual level. If healthcare is a serious concern, and it should be for anyone with a family history of chronic illness or anyone who is self-employed and currently carrying their own insurance, your number needs a dedicated healthcare reserve sitting in a health savings account. The HSA is the only triple tax advantage vehicle in the American tax code. Contributions are tax deductible, growth is tax-free, withdrawals for qualified medical expenses are tax-free. There is no other account like it. If you are eligible to contribute to an HSA right now and you are not maxing it out, you are paying unnecessary taxes on money that is eventually going to a doctor whether you like it or not. Variable 3, geography. The $847,000 number assumes a national average cost of living. If you retire in Manhattan or the San Francisco Bay Area, that number is laughably insufficient. If you retire in Tulsa, Oklahoma, or Greenville, South Carolina, or Albuquerque, New Mexico, it may overstate your needs by 30 to 40%. Moving from a high-cost state to a median-cost state at retirement can be worth more in effective net wealth terms than 5 to 7 additional years of savings contributions. Not metaphorically, literally, the math. If your current spending in a high-cost area is $80,000 per year and moving reduces your annual expenses to $52,000, you've permanently reduced your required portfolio by $700,000 at a 4% withdrawal rate. $700,000 of required savings gone because you chose a different zip code. The people retiring to the Carolinas and to Boise and to the Gulf Coast of Florida are not all chasing sunshine. Some of them are doing arithmetic. Variable 4, spending flexibility. The 4% rule is derived from worst-case historical analysis. It assumes rigid withdrawals same amount every year, regardless of what markets are doing. If you have any genuine spending flexibility, if you can reduce discretionary expenses by 15% for a year or two during a market downturn, your actual safe withdrawal rate can realistically be 4.5 to 5% without materially increasing your risk of running out. That flexibility reduces your required portfolio by $150,000 to $200,000. The question isn't just how much you have, it's how attached you are to a specific number on a monthly basis. Now, there is a psychological dimension to all of this that I want to spend a few minutes on because I think it is the most underrated variable in the entire retirement equation. And it cuts in both directions, which is what makes it unusual. The financial services industry is very good, genuinely skilled at exploiting the fear of running out of money. That fear is real and legitimate and rational. People do run out of money in retirement. It happens. The fear of it shapes almost every financial decision people make in their 50s and 60s. But there's a research finding that doesn't get nearly as much attention. A study from the National Bureau of Economic Research published in 2018 found that Americans systematically underestimate their spending in retirement by approximately 20% in the first 5 years. Not because they are foolish or dishonest with themselves, because they have no reference point for decumulation. They've lived in accumulation mode for 40 years. They spend like they have a paycheck because for their entire adult lives, they did. FINRA published data showing that a substantial share of retirees with more than $500,000 in retirement savings spend down less than half of their portfolio over the course of retirement. They die with more than half the bucket intact. Not because they planned a large inheritance, because the psychological discomfort of watching a number go down, even on a schedule, even according to plan, is so powerful that they cut spending they didn't need to cut, avoided experiences they could have afforded, and spent their retirement being anxious instead of actually using the financial freedom they spent 40 years building. This is the other side of the brain problem. You save your whole life because scarcity feels dangerous and saving feels like control. Then you retire. Scarcity still feels dangerous. Watching the balance decline feels like dying, so you hoard. You treat a full bucket as a trophy rather than a tool. And you spend the last productive decade of your life in low-grade financial anxiety about a portfolio that by any reasonable measure you could afford to actually use. The money mistake isn't always spending too much. Sometimes it's spending too little, And that mistake is just as corrosive to the life you actually wanted, even if it doesn't show up in a spreadsheet as a failure. There is a version of retirement planning that gets this balance right. It requires running the actual math, your number, with your Social Security projection, with your real spending, with your healthcare exposure, accounting for the sequence of returns risk based on your planned retirement date relative to current market valuations. It requires doing that math once, seriously, with honest inputs. And then it requires trusting the math enough to actually live. Most people never do the math seriously. They outsource it to a general feeling, a vague benchmark someone mentioned at a party, or a financial advisor with a conflicting incentive. And then they spend decades either terrified that they're behind or terrified to spend what they actually have. This is not complicated. The tools exist. The research exists. The math is not hard once you sit down with it. What is hard is the behavioral piece, the willingness to assign a real number to your retirement instead of living in productive anxiety about an undefined monster under the bed. Let's talk about fees one more time because I want to leave you with a specific actionable number before the takeaways. Go to your 401k right now. Find the expense ratio on every fund you hold. If you are in an actively managed fund, charging 1% or more, I want you to understand what that costs over 30 years. On $100,000 invested today, growing at 7% annually, a 1% annual fee versus a 0.03% fee costs you $86,000 on $300,000, which is somewhere around where a lot of people reading this are, that fee difference costs you $258,000 over 30 years. That's a second car. That's 4 years of college tuition. That's evaporated silently while you thought you were investing it. There is a reason Vanguard has $4.9 trillion in assets under management. It is not marketing. It is math that finally became accessible to people who are willing to look at it. Lazy investing built more fortune than crypto memes. I mean that as a literal, empirically supported statement. The boring strategy, broad index funds, low fees, maximum contributions, Social Security optimization, a written withdrawal plan, a 2-year cash buffer has produced better outcomes for more people over more decades than every sophisticated strategy, every leveraged play, every asset class that went viral on social media. The exciting strategies get the attention. The boring strategy gets the wealth. 3 practical takeaways. Specific ones, not generic. Takeaway 1, calculate your actual retirement number using this exact formula. Take your estimated annual spending in retirement. Subtract your projected Social Security benefit. Look it up at ssa.gov right now. It takes 4 minutes. The number is there. The difference is your portfolio funded gap. Divide by 0.04. Add a healthcare reserve of at least $60,000 for a single person or $120,000 for a couple, ideally inside an HSA if you're eligible. That is your real number. Write it down. It is probably different from what you assumed. It might be lower than you feared. It might flag a problem you had not identified. Either way, the known number is infinitely more useful than the vague dread. Takeaway 2, audit your fee exposure this week, not someday, this week. Log into every retirement account you own. Find the expense ratio on every fund. Write down what you're paying. If you're in any broad market index fund charging more than 0.1% annually, move it to the equivalent Vanguard, Fidelity, or Schwab index fund at 0.03 to 0.05%. The transition takes 30 minutes. You will not lose any market exposure. You will, over 20 or 30 years, save a genuinely life-changing amount in compounding that currently flows to a fund manager instead of to you. Takeaway 3, build a sequence of returns defense before you retire, not the morning after the market drops. This means 3 things. First, a written cash reserve policy, 2 years of expenses in cash or short-term treasuries outside your equity allocation. Second, a written dynamic withdrawal rule, a specific percentage reduction in discretionary spending if your portfolio drops a specific threshold in a given year. 20% drawdown triggers a 12% spending cut. Whatever works for your situation, write it down before you need it, because you will not think clearly when you need it. Third, Even a small income stream in the first 2 to 3 years of retirement, enough to cover 30% of your expenses, eliminates the scenario where you are forced to sell into a falling market to pay your electricity bill. Kevin, mid-2025, hired a fee-only fiduciary advisor, not a salesperson, a fiduciary, paid flat hourly rate. She didn't tell him anything magical. She told him his withdrawal rate was too high and showed him what the math actually said. She showed him his Social Security claiming decision was costing him real money over a lifetime horizon. He delayed his remaining claim. He reduced withdrawals to $48,000 for 2 years. He picked up a 2-day per week consulting arrangement through a former contact work he actually found interesting. By mid-2025, his portfolio had recovered to $910,000. The panic attacks stopped. Kevin's bucket didn't need to be bigger. Kevin's bucket needed fewer holes. The industry will keep telling you the number is bigger. The industry will keep moving the goalpost. They will find new reasons why 2 million is the floor and 3 million is the real target, and why you should probably keep your assets under management with someone who charges you for the privilege of keeping you scared. Run your own math. The research is public. The formula is not complicated. The number, for most people, is more achievable than you have been led to believe, and the plan to protect it is more about behavior than balance. That's it. Go run your number.